For The Street in New York, I'm Jill Malandrino along with Jack Mohr, and together we bring you the trading week ahead. And Jack, what a week it was. If we take a look at the 5-day on the S&P, it's safe to say that volatility came back into the market and that dip buying was not there.
Right. I think the market had a lot of trouble digesting earnings, and I think I'm having trouble digesting earnings because what we're looking at is we're looking at companies that almost across the board are missing on the top line, and I think analysts are understandably having trouble quantifying the FX impact, foreign exchange impact, and so I saw a lot of top line misses, but bottom line beats, and so the earnings per share, in many cases, these companies are beating on that bottom line even without that revenue growth, that tailwind, and without even organic growth. And I think that what they're doing is some of the lower quality companies are pulling some tricks out of the bag, maybe having different amortization costs, or what they'll do is that they'll the tax rate seems almost conspicuously low, and so they just I feel like there's a lot of momentum, a lot of room, a lot of levers that these companies can pull to beat on the earnings line. But some of the higher quality ones, and I'd point to a Google, Apple certainly, and even like a Microsoft. This is over the past week and a half. These guys are growing their margins, and I think that's the most compelling side, because if we said 2 years ago that no one thought that people could continue growing margins, right? And that was such a trend for the last few years. And I think right now to see that they're still finding ways to be efficient to scale is very impressive, and I kind of like that.
Well, I think it's really interesting that you're mentioning larger legacy tech names, because we have not seen that follow through over the past few years, and you're starting to see IBM make those acquisitions and investments in areas like cloud. For example, Salesforce.com, which skyrocketed this week. One of the speculation rumors out there is that IBM or an Oracle, an SAP, or Microsoft could potentially be looking at that, because these legacy names know they've missed the entry there, and they certainly have to catch up. But let's look at the trading week ahead, because this could possibly be one of the busiest ones all year. In addition to a really full earnings calendar, we have key jobs data, including the ADP employment report, jobless claims, which we get on every Thursday, but non-farm payroll data on Friday is going to drive headlines and drive the market. In addition, we have Federal Reserve President Janet Yellen speaking, and 4 or 5 other Fed heads making the rounds. And of course, the commodity FX and US dollar impact trade is going to continue to drive the tape as it has been for all of 2015. Let's focus on a name that you and Cramer have reporting next week, 21st Century Fox.
Yep, so we bought it about a month ago, and I love this name. It's been lagging its media peers over the past year, certainly year to date, and definitely lagging the broader market, because everyone hates media right now, and understandably so in a lot of cases. You see like a Viacom just having to take I forget, but hundreds of millions of dollars of charge to essentially admit that their content is not as valuable as it was in the past. But I think Fox has valuable content, and you can look on just from a broadcasting perspective, Empire, Gotham, American Idol. I mean, these are top 2 franchises that usually have a long cycle. That's what we see in media. Usually, great shows have a long 7, 8 year cycle where they can churn out that content and have a strong advertising base and audience base. But also, it has this local sports content, live sports content. It's Fox Sports 1, also NFL on Fox, NASCAR, all of that. But then when you're trying to watch one of your local baseball games or hockey, a lot of times it's on your local Fox channel, and those affiliate fees are higher than any other fees. I think 38 of the top 40 affiliate fees are local sports or live sports based. So and I think that the other thing is they have 8 of the 10 highest affiliate fees. So that's very impressive. Lastly, the international growth opportunity is incredible here, and I'd point to the India market, which is so hot right now, growing so fast, and it's not dependent on GDP. It has 200 million in EBITDA right now that it generates in that market. I think easily it can grow 40% a year for the next 5 years, get to almost $1 billion in EBITDA, and that's just incredibly impressive. It owns 30% of that country's content, and even though FX headwinds are definitely considerable, what they're doing is instead of just they're reinvesting their proceeds in that country into local currency. So the actual cash impact is nothing.
Well, it's interesting because not only does it apply to the cable providers, but it's also Amazon and Netflix, where content is king. And that certainly is the story in this space. Let's take a look back into the commodity complex at energy, because crude certainly had a move this week if we take a look at the 5-day. And it's interesting because not only did it break through the key technical level of 55, most technicians think 60 and 62.5, 65, those round numbers are the next stops to the upside. Fundamentally, while inventories grew for the 16th week in a row, gasoline has been drawing down. So those refiners are going to need that crude oil to produce the end product. And I really think that's where you're starting to get the bid in the stock. And finally, we'll wrap it up with gold. If we took a look at the 5-day on that, and back to what you were saying about the US dollar, as that's moved higher, gold has certainly come down because the trend over the past few weeks has been trading around that $1,200 level. Now we're at about $1,170. So it's going to be really interesting to see, do we get closer to $1,130 or back up to a $1,280? But for sure, I think, in terms of what you're looking at with earnings, is that US dollar and FX impact is really crucial this quarter.
Yeah, it's really moving the needle, and we saw Target lows, a lot of our retail names, Lululemon, just really fall back considerably this week, and a lot of that was due to the weakening of the US dollar in the early stages of the week. And so I think that we kind of forget that sensitivity. We loved having that upside as the dollar strengthened, but there certainly is sensitivity, and as crude moves higher, it's hurting these the shares of these retailers, because a lot of the bet originally, including why we invested in Target in the first place, was because of low gas prices. So there are all these different variables that are in play that I think it's really important to have a grasp of how that's going to affect your stocks individually.
Right. Well, you know what? This is what everyone's been looking for, better entry points, because it's been so hard to pick points as the market over the past 6 years has been on a significant uptrend. So these tiny little pullbacks can be gifts for longer-term investors like our audience.
Oh, it's great.
All right. Thank you very much, Jack.
Thank you.
For TheStreet in New York, I'm Jill Malandrino.